Hello and welcome to Compass Global Markets Weekly Update. I'm Tony Boyajian. It's all about the US dollar this week, with the US Senate voting 51 to 49 in favour of approving tax reform. The Republicans have agreed on a blueprint for the 2018 budget. Now, this is a long process that could take several months and it could have many twists and turns yet to come. But the US budget surplus for September actually narrowed from 73 billion to 8 billion. But when we look at the fiscal deficit in the US, it's widened to $666 billion. That's the devil's number, or 3.5% of GDP, as record spending certainly outweighs receipts. Now, what does this mean? It's mean the US dollar has strengthened across the board, even though the $6 trillion worth of tax cuts that President Trump has promised will sharply reduce government revenues. We need to watch out for Friday's third quarter GDP data for further outlook. Now, current US Fed member Jerome Powell, this man is a dovish Republican. He has similar policy preferences to the current Fed Chair Janet Yellen. Is now favoured by President Trump to be the pick for the next Fed Chair. Now, the markets like this news because, like Janet Yellen, Mr. Powell tends to prefer a steady and consistent monetary policy, and the equity markets will like that, and so does President Trump. Now, lower taxes in the US may lead to stronger economic growth and certainly higher inflation, and that's the reason why the Trump trade may return, and as US tax cuts raise optimism in the US market. We've seen the US dollar rise against the yen by 2.5% over the past week. Now, the yen is likely to remain weak after Prime Minister Shinzo Abe from the Conservative Liberal Democratic Party won the recent Japanese election. This will allow for a change in the constitution. They'll legalise military activity in Japan, as well as maintaining their strong alliance with the US and keep monetary policy where it is at the moment. China's economic growth has remained its strength. GDP for the third quarter came in at 6.8%, which was as expected and well ahead of the official forecast of 6.5%. In Australia, the key event this week will be tomorrow's, Wednesday's CPI number for the third quarter. The headline forecast is for 0.7% or annualised figure of 1.9%. Now, that's well below the Reserve Bank's 2 to 3% threshold, hence the reason why interest rates remain on hold. Of that 0.7% in CPI, more than half of it is attributable to the spike in energy costs. Meanwhile, Australia's jobs data continue to improve. We've seen 12 consecutive monthly rises in jobs, and the unemployment rate has fallen from 5.6 to 5.5%. The Aussie dollar, however, does remain pressured on the downside due to US dollar strength. We expect the Aussie to remain in a 77 to 79 US cent range this week. It looks like this stagnant wage growth, rising electricity costs and increased mortgage repayments are certainly squeezing consumer sentiment. The New Zealand dollar has fallen a further 3% since the forming of a New Zealand government, with Labor Party Jacinda Ardern appointed the new Prime Minister of New Zealand. Now, the New Zealand First Party will support the Labor Party. They will form a coalition government, and the Green Party will also support this going forward. We've seen the Aussie-Kiwi exchange rate trading at 18-month highs around that 112 level. Now, the ECB meeting on Thursday night will be the pivotal thing for the euro going forward. They're expected to leave interest rates unchanged. Draghi wants a weaker euro as it will make their exports more attractive and push imported inflation a lot higher. So all eyes on Thursday's ECB meeting for some direction on the euro. Thanks for watching. Don't forget to watch us on Sky Business News every Thursday lunchtime at 12:15 for our latest market wrap. I'm Tony Boyajian, Compass Global Markets.